Talk TwinCities.com. I'm Eric the Lone Guy along with Donna, Cheryl, and we're welcoming our special guest Elise Jensen of Azure Wealth Management. She's here today to help save money, make money. Welcome, Elise.
Thank you. I'm excited to be back.
How was Turkey Day for you?
It was wonderful. We spent some time up north with family, so it's always fun.
Sounds good. All right.
So we were looking over the average savings rates, as we start thinking about financial tips and year-end planning. And one thing that's pretty amazing is the age group, 18 to 35, their savings rate is negative 2%.
Yeah, that doesn't surprise me, especially with all the clients that I see, living with their parents. They've still got a lot of student debt to pay off. They maybe are prioritizing things incorrectly, purchasing a new vehicle, going out with friends a little too much.
Yeah, that's one of the things I've heard is they're more focused on their social life and traveling than they are saving money. And that's definitely been impacting the real estate market because we've been seeing the first-time home buyers are down this year, but projected to change. So we're hoping that more people are living with mom and dad and starting to actually save some money. So on the positive side, the older we get, the more we start saving. Age 35 to 55, savings rate is 3% of their income. 45 to 54, 6%, and 55 on up is 13%. Does that sound pretty good?
It's still terribly, terribly insufficient if you're trying to reach financial goals. I'm looking at, 55 plus saving 13%, and that's realistically what most younger Americans should be saving in order to be successful in reaching their final goals.
Boy, we've really got a long way to go to get to that, starting at a negative 2%. So what's your recommendation for how do you get started saving? Where would you start putting your money in? How much would you recommend putting in?
The last time I was on the show, we talked a lot about just the appropriate order for putting together a financial plan. And the first place you want to save is your emergency fund. You need to have liquid cash in case something goes wrong, because otherwise your emergency fund is going to be mom and dad, it's going to be credit cards, it's going to be loans. So first and foremost, people should have an appropriate amount of savings before they then take the next step to make sure they have the appropriate defensive planning in place. Make sure you have health insurance. Obviously we have to these days, but some people still don't. Appropriate life insurance. Make sure you're protecting your income, and then it's a question of, okay, now where do we save in our retirement plans and what do we have available?
And so along with that then would be establishing a budget.
Oh, absolutely. I mean, it all starts with a budget. It's no different than anything in your life. If you're eating Doritos and never going to the gym, it's not a surprise you're probably not going to be in peak physical condition, just like if you're...
They lied to me.
I know, right? It's a simple concept.
That was a health food.
But it's the same thing, people are just puzzled, they don't know where to start. Well, the first step is to be spend less than you earn, okay?
Right. That seems pretty basic, doesn't it? But especially with young people, all you have to do is look at all of those, you are pre-approved for this credit card. It seems like they're coming every week.
Oh, absolutely. And nowadays, we have all kinds of, money is at your fingertips. Debt is at your fingertips. You have everything on your iPhone that you can just, go out and scan and buy, and it's easy to lose track of what you're spending. But on the other hand, it's also easier than ever if you really want to pay attention to what you're spending because of applications like mint.com, or most banks now have spending reports, which again, a lot of people don't like to look at, but that's usually the first step, is just get a handle on what we're actually spending money on. And 9 times out of 10, it's going out, it's eating, it's drinking, it's, recreational spending, entertainment-related spending that gobbles up a really big portion of people's budgets.
Yeah, and I'll bet you if more people walked around with real cash in their pocket, they would be much more careful about what they're ordering at the restaurant,
Absolutely.
how many drinks or bottles of wine they're going to be ordering.
Yeah.
So, all right, well, that's a really good tip. One thing I heard about credit cards, typically, I've always heard that with credit card debt, you should take that credit card that has the highest interest rate and start paying it down. And in one of the books I was reading, they were saying, take the one that has the lowest balance on it.
Yep.
And pay that off first, because then you've got one less card and you feel like you've actually accomplished something.
Yeah. What's psychologically correct is not always mathematically correct. And just getting my clients to actually take a step forward on paying down debt, that can be a really effective method. Absolutely. And then once you've paid off that smaller credit card or that smaller loan, you can take what you were spending on, monthly payments there and apply it to your larger loan and snowball it, so to speak.
Yeah.
Let me add a little bit about credit just while we're here. Pay it down to, first of all, leave the cards open. You might, if you pay them off, great, but leave them open
Yeah.
because that helps build your
Right.
credit. Also, if you're working on paying down debt, ideally you want to be at or below 50% of the limit. So it depends where you're at in your planning phase, but if it's coming up in the next 6 months to a year and you've got a low balance credit card, let's say $300, $500, if you can pay that down to half, that alone, you might be surprised, that can jump your credit scores 15, sometimes as much as 20 points.
And parents and partners, parents and spouses can be an excellent resource, because so often I come across my clients that have, are carrying credit card debt, and it is either from an emergency they didn't foresee because they didn't have an appropriate emergency fund, or it was just from a period of their life where they were irresponsible or going through some type of hardship, during college, maybe right after college, when they still didn't really understand how detrimental it could be to your long-term goals. So having those conversations is key.
Right, and really to start planning when you're young. I know one of the other reports I was reading is with college students, there isn't a whole lot of difference in your earning potential for most jobs if you do a 4-year degree at an expensive college versus spending less money the first 2 years at maybe a junior college that will transfer over, and that could help save thousands of dollars too.
Absolutely. And for people, I have a lot of friends that are maybe in industries or jobs where they don't have as much earning potential long term. It's even more important to take a look at your financial picture young, because you have a much longer amount of time to save money, and you can save less over the long run than waiting 10, 15 years and then having to save a much larger percentage of your income if you maybe are, an artist or something that doesn't have as much income potential, or, in a field like that.
So let's say you are ready to actually start putting money away. Where would you suggest people do that? How do they get started?
Well, first of all, you can call someone like me at Azure Wealth Management and schedule an appointment to talk to somebody. It's generally free to consult with advisors. It's free to consult with me initially as well. And then, like I said, it's oftentimes the least sexy places are the places we start. Liquid savings, insurance planning. Everyone wants to talk about the hot new investments or the get-rich-quick schemes, but it's making sure that you have cash first, you have life insurance, disability insurance in place, health insurance, and then it's a question of, okay, what retirement accounts do we have available to us? Oftentimes your employer sponsors a plan if you are lucky enough to work for someone that has a plan in place. And I always want my clients to max those opportunities out first, because they're oftentimes less expensive to invest in your employer plan than it would be to go out on your own, where maybe if you're working with a bank or another advisor, there are annual account fees. If you're paying $50 a year to have a Roth IRA somewhere and you only have $1,000 in it, that fee is going to eat up the majority of any growth that you're going to achieve.
Right, and I've seen some plans too over the years where I'll go in, I'll talk to somebody, they'll say, okay, well, you are guaranteed, 5% on your investment annually, but then it's going to cost 2.5% in fees. So really, it's not that great. And then if the market goes down, you really have to analyze your risk.
Oh, absolutely. If it sounds too good to be true, it generally is. And we see that that's why there's so much regulation, and there's more and more regulation that we see around certain products in our industry that have a lot of guarantees. Stuff gets lost in the fine print. Fees get lost in the fine print. And I know very few of my clients really understand what they're spending on their financial plan until they sit down with me and until I openly disclose what they're spending.
And how can they get a hold of you?
They can call me at 651-300-2456.
And your website?
AzureWealthManagement.com.
So what type of advice do you have for life insurance? How would somebody determine how much they would need?
So it might sound sick and twisted, but life insurance is one of my favorite topics. It's kind of,
That does sound twisted.
it's very
Yeah.
misunderstood, but it can be really empowering for people to understand and take ownership over what they own. You know, on a really foundational level, there are two different types of life insurance, and you can really relate it back to homeownership in a lot of ways. You have a term product or something that's going to be there permanently. And a term product is a lot like renting your home, renting an apartment. You're gonna lock in a lease, you're gonna pay your rent every single month, and then at the end of the time, when you move out of your home, what do you have to show for it?
Nothing.
Nothing. But it,
Receipts.
yep, but it was less expensive, it was oftentimes more flexible. And then long term, if you were to rent long term, what is your rent gonna look like if you rented from age 30 to age 60?
It's gonna keep going up.
It's gonna keep going up. Unlike renting an apartment though, insurance is based on your age and your health. And so there's always that wild card of whether or not you're going to be able to even sign a new lease, or you might be homeless someday if
Right.
you have any kind of health issues. Permanent insurance is much like owning a home, where you lock in a rate that again is based on your age and your health. So think about, Eric, everybody always wants the lowest rates with you, right?
Yes.
Sore subject. If somebody comes to me when they're 25 years old, relatively healthy, they're going to be have far better rates than somebody shopping when they're 40, it might be a little overweight.
Right.
And that affects the amount of money that you pay long term for a permanent product.
Makes sense.
Yep.
We're coming back with more from Elise after the break. You can get a hold of her at azurwealthmanagement.com. I'm Eric, realtalktwincities.com, along with Donna and Cheryl. We're here every Sunday. You can reach out to us at realtalktwincities.com for all things real estate. We want to help you on AM 1280 The Patriot.